The change in China's exchange rate policy on Sunday, I guess over the weekend, essentially illustrated that China was now ready to move on the flexibility of the exchange rate, an issue which the whole world has been waiting for. I think what it indicated was that China saw that changing its policy was in its own interests. It's been in its own interest for probably a long time now. It really had to wait for the right opportunity to do this. And what do I mean by its own interests? Its stimulus program had succeeded. The risks of the financial crisis had more or less passed, and China could see that it was not going to be negatively affected. Its exports are booming. Its economy is growing very rapidly. China saw that not having the exchange rate flexibility was giving up a policy tool it could use to manage its economy, and therefore it essentially took the decision to move forward. The emphasis was on flexibility. It certainly didn't signal any major change in terms of the appreciation of the currency, although it acknowledged the fact that some appreciation was possible and likely to happen. But it really thought that the size of the potential appreciation was not the most significant factor. It also saw that it needed to remain broadly stable, so whatever would happen would be more or less modest, and it would take place over time. China was actually ready to introduce more flexibility in its exchange rate for a long time now, months probably. In some sense, all the political pressure coming from the West, coming from the U.S., to appreciate the currency probably delayed it, because China, as most people recognize, does not want to be seen as doing something based upon pressures from outsiders. For its own domestic audience, it had to basically say that we do something for our own sake. In that sense, this really is in the interest of China. It will actually allow it to deal with certain questions like, should I change my interest rate? Should I tighten my fiscal monetary policies? Can I afford to liberalize my capital flows a bit more? Having a more flexible exchange rate allows China to actually strengthen its whole economic policy management. People are, of course, debating the question of whether or not the G20 meetings next week meant that they really wanted to do it now in order so that President Hu Jintao would not be facing a tremendous amount of pressure from the others to do something. And I certainly think that's a realistic interpretation of what actually happened. The government doesn't like to go into these meetings with everyone focusing on the exchange rate. So from their own perspective, getting this out of the way was probably highly desirable. If this meeting hadn't have occurred right now, maybe they would do it later, but not much later. In some sense, they're also wrestling with the collapse of the euro. And the collapse of the euro actually offered a really ideal timing for them, because with the euro falling, the dollar was basically appreciating a lot, and the renminbi was appreciating along with the dollar. So something like a 15% appreciation took place over the last several months. Now, this appreciation actually gives China a lot more flexibility. It doesn't have to appreciate as much as it might have had to. It could actually adjust the exchange rate either way. My guess is that China will now say, yes, I will introduce flexibility, but given what's been happening, given the movements of the euro, given the increased volatility, the renminbi, the yuan, could move either way. It could move up, it could move down. On Sunday, the renminbi appreciated by 0.4%. Today, it depreciated by 0.2%. And people were somewhat surprised, but they shouldn't have, because essentially what China was trying to say is it could go either way. And now the commentators are really talking about the fact that China wants to make it very clear that the exchange rate flexibility is not a one-way bet. It's not just going to be appreciation. And I think if they're successful, maybe over the course of the coming year, the renminbi will move in ways which are not predetermined by market speculators. And China really needs to get away from that. When there's a lot of instability, when there's a financial crisis, when there's uncertainty in the world, the Chinese basically like to hunker down a little bit. They like to make sure that most things are under their own control, and exchange rate is one key instrument. The best example of this is probably during the Asian financial crisis. Currencies around them collapsed, there was a lot of discussions about whether China should depreciate the renminbi at that moment in time in line with the declines in other regional currencies, but they held it very constant. They also realized that by holding it constant, it created what I would call anchor for other countries. It helped stimulate demand, maintain stability, and in some sense it helped bring back Asia as a whole faster. Now, by the same argument or reasoning here, the holding of the renminbi constant over the last couple of years has probably helped Asia as a whole to recover from the financial crisis and to move forward faster than might have been otherwise. All Asian countries, in fact, have seen growth rebound very quickly over the last 6 or 7 months. Trade volumes have jumped. South-South trade within Asia has ballooned. And this has accounted for maybe a quarter or half of what I would call the entire growth in global GDP. So the rebound in Asia as a whole, with China as an anchor, has probably been seen as very positive, certainly from an Asian perspective. For them to be able to maintain what I would call a truly flexible exchange rate, there's got to be a sense that money is flowing in, the money is flowing out in line with trade patterns, in line with ordinary capital flows, and not driven by speculation. There have been various studies over the last several years which have estimated that maybe 20% up to 40% of the capital flows going into China was largely driven by a presumption that the renminbi would appreciate, so people would have nothing to lose. After all, if the renminbi appreciates by 6 or 7% a year, interest rates in Western economies, I'd say, are 2 or 3%, then you'd have a guaranteed 3% in return. And that would just encourages more capital flows, more speculation. So China's got to get into a situation where that kind of one-way bet, one-way change in the exchange rate is no longer what's driving the market. Now, for this to happen, there'll be many things taking place. There's going to be probably a little bit higher inflation in China. Assets, housing is very, very high. So the potential for people to speculate in the real estate market is probably moderating. China realizes it doesn't have to export as much in the future to generate jobs as it did in the past because the labor shortages are now emerging. China also is realizing that the commodity composition of its exports, which have been heavily in the favor of what I call light manufacturers, labor-intensive products, are no longer needed. They need to move to higher valued products. Appreciation of the exchange rate will help in that regard. China also realizes that the location of activity maybe it should relocate itself from the coast areas into the poor interior. Some modest appreciation is helpful in that regard. So you take all these factors together, what China sees is that, yes, a little appreciation will be fine, but the trade balance itself will work its own way out. Capital movements will probably become more liberal. If that's the case, money will start flowing out of China in search of returns elsewhere. And that I wouldn't be surprised in a couple years down the line if people start to say, well, they don't know whether the exchange rate is going to get stronger or weaker. And in that sense, the flexibility policy will work fully. If you talk to economists, you get every single answer in the book. Some will say it's severely undervalued and must appreciate by 20%, 40%. Others run these very elaborate models and say the renminbi seems to be fine. What that illustrates, of course, is there's no real answer as to whether the renminbi is under or overvalued. If you just look at trade data, China is generating significant trade surpluses. But I need to remind everyone that these trade surpluses really increased precisely during the period of time when the renminbi was appreciating, from about 2005 to 2008, booming trade surpluses. The great irony is that when the renminbi was fixed, pegged to the dollar, and no longer was appreciating, trade surpluses actually came down. So this argument that appreciating the exchange rate will moderate trade surpluses certainly isn't true given the evidence of the last couple of decades in time. There are all sorts of forces at work driving why exports or imports are changing. Now, you have to look at the exchange rate and its relationship to exports and imports and capital flows in a very, what I call longer term cycle. What's really happening is that Asia as a whole, post-Asian financial crisis, has been building up its foreign reserves. It's increased its savings. It's taken a lesson from the financial crisis to realize it needs a greater security, a blanket to cover potential volatility in the future. Now, I personally feel that that period of time is just about over now. 10 years of what I would call restoring its financial strength, building up its reserves, has given Asia what I would call a safety blanket. And that's why you see many countries in Asia talking about the fact that now is the time to moderate the trade surpluses. Now is the time to deal with inflation issues. Now is the time to focus on consumption and internal demand. Now, it's also a recognition that they don't need to grow as fast. What people don't fully realize is that if you rely largely upon domestic demand for growth, you're also accepting the fact that growth will be lower. And that's because domestic demand cannot generate growth in excess of 5, 6, or 7%. But a trade-based kind of a growth strategy, outward orientation strategy, can generate growth of 10%. So I think the really tricky issue, or the issue that people haven't fully comprehended, is that Asia as a whole is moving to probably a period of what I would call somewhat slower growth. And they're more or less saying that's okay. That's okay because we've reached that point in our own stage of development that it's okay. Greater flexibility, first of all, gives China another tool for what I call macroeconomic policies. You have interest rate policies, fiscal policies, monetary policies. By keeping the renminbi fixed to the dollar, they essentially lost one tool that they could use to essentially guide the economy. And now that they have it, they have more flexibility. They can deal with inflation better. They can moderate investment better. They can deal with potential asset bubbles better. So overall, it's another tool. It's helping them. Secondly, I think it's consistent with what I say is a reorientation of China's own strategy. It's now beginning to say we need to increase consumption. Stronger renminbi means that imports are cheaper and people consume more and import more. It's also saying that we don't need to produce as many so-called labor-intensive products. We need to move to higher valued products, and we need to provide that incentives for people to do so. It's also saying that the location of activity could become more focused toward the central portions of China, not just along the exporting coastal areas. And that's in its own interest because inequality in income is becoming a serious problem in China. And one of the ways of dealing with that is to focus upon the consumption-oriented service sectors, and they tend to be more in the central portions of China. So all in all, I think this appreciation strategy is part of a general refocusing of what they want to achieve, and it's sort of like consistent with their longer-term objectives. There's a political issue, and the political issue is that as long as the renminbi doesn't move at all, it creates the image that China is manipulating the exchange rate. However, as many people have noted, there are many countries with fixed exchange rates. You take a country like Hong Kong. Hong Kong dollar has been pegged to the US dollar forever, but no one ever accuses Hong Kong of manipulating the exchange rate. The euro, creating the euro is essentially creating a single exchange rate for all the European countries. And big debate in that part of the world, of course, is whether this is creating a problem between the Germanys of the world and the Greece of the world. So just having a fixed exchange rate by itself is not the issue. I think and one reason why it's not an issue is that the problem will solve itself anyway. It solves itself through price changes and inflation. So the exchange rate by itself is not what I would call a fundamental tool in altering trade flows. What really alters trade flows between countries or the imbalances is savings and consumption rates. And the big issue in China is whether it will consume more and save less. And the big question for the United States and the West is whether they will in fact start to consume less and save more. And if that happens on both sides, then these imbalances will be moderated. So I don't think that the exchange rate per se is going to probably make much of a difference in terms of these imbalances. It will shift the debate, I think, in a more healthy way to focusing more about government fiscal policies, consumption policies, savings policies, structural issues. These are the big issues which affect trade balances. The appreciation by itself, I don't actually think will alter U.S.-China trade imbalances. It may shift somewhat the pattern of trade within Asia. By that I mean, of course, that what is happening is that the export surpluses of China is really the export surpluses of Asia as a region, because Asian trade is primarily in parts and components, final assemblies in China. And then when it's shipped off, it looks as if the whole trade imbalance is a Chinese imbalance. It's actually not. It's an Asian imbalance. The American public is hoping that a Chinese appreciation of its exchange rate will lead to more employment, more jobs, a stronger trade pattern in the United States. And on this, I would say one needs to be very cautious. Most observers are commenting on the fact that appreciation in the renminbi by itself probably won't alter the U.S. Trade position. Some would actually argue that the U.S. may actually come out worse in the process. The cost of its imports will be higher. The cost of U.S. final products, consumption levels will probably be hurt in the process. There may actually be what I would call a small decline in real wages in the United States because prices will go up, although earnings are not going up as much. So the kinds of outcomes that may come from this in terms of its impact upon U.S. welfare or public opinion is, frankly, in my view, potentially more negative than positive. However, what this outcome will do, I think, in terms of Asia, it will actually start shifting some of the labor-intensive activities to the poor countries in Asia. It will probably encourage China to move to more higher-value activities. It will probably lead to higher global prices, and therefore global consumption in real terms will actually decline a little bit. So there are pluses and minuses to this, which I don't think have been fully brought out in the debate.